Well, good afternoon, everyone. Welcome back to the channel. So we got our latest dividends for YieldMax today. So let's go into all of those. And I'm going to go more in depth into the dividends than I usually do in this video. So it should be a good one. Okay, to start off, let's go over here. And here's what we've got for the month of May, starting with Tesla. We've got 69 cents, which still seems pretty high based on how the share price was doing for most of the month, most of last month. And then for OARK, we've got 53 cents. So the distribution rate for both of these is still above 50%. For Aptly, if you round up, we're at 34 cents. For NVDY, we're at almost $1.20, which is pretty good. But it's a 56% rate based on the share price. For AMZY, we're almost at $1, which is a 49% distribution rate. For FBY, we are at 90 cents, which is a 55% distribution rate. For GUI, we are at 66 or almost 67 cents, which is a 44% distribution rate. So Google stock had a really good earnings this last quarter, and they actually announced a dividend themselves. And then if you look at NFLY, we are at almost $1, 96 cents or 97 cents if you round up, which is a 67.74% payout. For Coney, we are doing incredible still. We're at 109%, $2.28 in dividends per share. MSFO, 57 cents, which is 32.5%. DISO is starting to come up, 70 cents. So Disney stock, oddly enough, is starting to recover. Actually, they're having a pretty good year. Maybe Mr. Iger might be finally turning the company around. At least a lot of the bad headlines have started to die out anyway. But that's a 41% dividend rate annualized. XOMO is 33.5 cents, which is a 22.41%. So one of our lower ones, but this one also doesn't fluctuate as much either. JPMO is 42 cents rounded up, which is a 25% payout. AMDY is 51 cents, which is 37%. PP, one of the best named funds, most aptly named funds ever. For PayPal is 94 cents, which is 56.74% annualized. SQY is $1.12 rounded up, which is almost 62%. Incredible. MRNY from Moderna is almost 95 cents, which is a 53.25% payout. The AIYY one, which has been hit hard because of AI, for some reason, this AI.C3 hasn't been doing too well. It's a 41-cent payout, which is almost 40% if you round up. And then last but not least, certainly not least, MSTR or MSTY based on the MSTR stock, $2.52. This is a 103% payout. And of course, Ybit and Crash are too new to have dividends yet. So keep in mind, this is the dividend cycle for the covered call ETFs. For the fund of funds and Ulti, those are on a mid-month schedule. So we've got two separate dividend dates. So most of you, if you're looking for like weekly dividends, well, of course, Roundhill has that, but you can pretty much like stagger your investments to get um, basically a dividend payout like every week. So I know some of you, were really big on having that. So the X date is Monday because we got declaration date today, which is Friday. So the X date is May 6th, record date May 7th, and then they're paid May 8th, which is Wednesday of next week. Okay, so let's do some comments here. I'm about to cover that dissector. Be patient because I'm going to get into that. Yeah, greetings. YMAX guesstimate, close to what it was last month, but we'll be covering that closer to the time. Good morning. You must be on the West Coast. Why does MSTY 30-day yield say 0.25%? That's another story. Story for another time. The 30-day SEC yield, someone explained that to me before, but oh, new investors on. Welcome. Haven't seen you in a while. Okay, so these dividends look great and all. Ah, Richard, your line has been stolen again. Late to the party. Um, so here's something really key that I'm going to point out in this video, which I've actually never done before. And some of you all are probably going to misunderstand this, and it is what it is. I'm just the messenger. But um, these dividends, a lot of them look great on paper, a 50% yield. But like Dissector alluded to, a portion of this is return of capital, which means actually them paying your money back to you, not an actual dividend. So I'm actually going to go into the tax document and show uh, how many that this is the case for. It's not as bad as I thought because I actually saw this covered on another channel, and I think uh, this started out early on with some of the funds where of the dollar payout, it was only like 9 or 10 cents that was the actual dividend. That was the case on some of them, but I'm going to cover the whole picture like I usually do. Just like when I say YieldMax, out of the 22 or 23 funds, 16 of them are up in total return. But I point out that the underlyings always outperform, because with the covered call strategy, the underlying investments are going to outperform. Dividends are a big psychological thing for people. I feel like you're getting income, but the thing is, in a classic dividend model, the income is coming out of the price of the stock or the fund. So the fund has to recover in order to get back to where it was. So it's not free money. That's a big misnomer that dividends are free money, of course. So welcome to the later joiners here. Okay, so here we go. So I'm going to go in depth on all of these. So if we go to the 2023 year-end tax document for YieldMax, here's what we're going to see. And this isn't as bad as I thought, because when I saw this covered on another channel, I thought, oh my God, like, did I completely miss the boat on this? So what you're going to notice for Tesla, okay, going back to January of 2023, for the first month of last year, the dollar payout, 8 cents of that dollar was actual dividend. The rest was just basically return of capital. In the ensuing months, less than 8 cents was actual dividend, all the way up to October. And then what do you notice? By November, it became 100%. It became 100% dividend yield. So the 58 cents they paid was all a dividend, where that wasn't the case before. So something changed. I think that maybe there was some backlash or something. I've actually never covered this with Jay, but if I get him back on, I'll be more than happy to. I know that there's other channels out there that are, upset about how many times I've had Jay on. So it wouldn't surprise me if, I don't know. I won't get into it, but if I do have him back on, I'm always going to ask him tough questions. So this is something that I haven't pointed out up to this point. Um, I want to say this has been brought up by several of you, um, but you'll notice this. Okay, so here's what you'll notice. So Tesla started dropping even more so in November, and what do you notice that changed here? Between October and November, the dividend became 100% dividend. It wasn't just return of capital. So with that happening, that actually, not only that, but of course, Tesla stock dropping, that accelerated the drop of this fund, in my theory. Unconfirmed, but that's just my theory. Okay. I'm not stating that as fact. But so on the other ones, like Exxon, the dividends they paid were all dividend. There wasn't any like return of capital issue. Um, according to this document. Same with Square or Block. Same with PP. You would expect an issue like this to happen with a fund named PP, but with NVDY, it happened a little bit. So it was like a 10-cent differential. See where it says income dividends and distribution per share. So the difference between the two columns would be the difference basically between like return of capital, I believe, return of capital and like the actual dividend itself. So this wasn't the case for MRNY in December. It wasn't the case for MSFT. It wasn't the case for the Netflix one. It was slightly the case for NVDA or for the NVIDIA one. But you'll notice they stopped by November. You see, it stopped. So it was like a 12-cent differential here It was typically, you can see it was like a 12-cent differential, but it stopped in November. So that's definitely interesting. Let me do some more comments here. Is return of capital really a bad thing? I don't know. I can ask. Is it bad? Let's see. Yep, it's horrible. Actually, it says ask again later. Um, Outlook not so good. So I'm going to explain this after I stop laughing at your comment here. Um, okay, so the way I view it, and I could be wrong, but I view return of capital as what it says. So it's like if you're investing, they're like literally giving your money back to you with return of capital. So with the Tesla dividends, that's how it was starting out. It was mostly return of capital. And I don't know. I don't want to speculate. Maybe that was because Tesla was fluctuating so much. But then why would they do it with NVIDIA, right? Because NVIDIA was running up so high. Like, what's the need to even do it? Just give the investors like the full income dividend. So that's something, like I said, that I have no problem asking him when he comes back on. Okay, but anyway, that's one page of 4. We still got 3 more to go. So here we go. And I always try to be fair, so I'm not just going to cherry pick Tesla. Tesla was the worst example that I saw, but the other ones so far on this page, only one other one did it. So let's go back to, let's see, page 1 of 4. So I'm looking at, so the Apple one. Let me make sure, okay, you all see the same screen that I do. Sold all 500 shares YBTC 58 cent $58 10 days ago. Got 600 YBIT. Why? Like, it's new, it's a brand new fund, but do you feel like this one's better than the other one? I'm just wondering. Because I'm not actually in either. I'm in Beto. I know one of them is actually indexed for Beto, which is interesting because it's like a kind of like the derivative of a derivative thing. But anyway, okay, so because Beto is actually invested in, like, Beto, if you look at it, it's like a derivative of Bitcoin, right? It's a dividend income ETF of Bitcoin. And so now we have ETFs that are indexed for Beto. So it's like that domino thing, so to speak. All right, so Aptly, so at first, our first dividend that we got in June of last year, of the total distribution per share, 5 cents of the first 29 cents was income dividends. And we saw this happened all the way up until November. So November and December, it equaled out. So they stopped doing this by November, and we're noticing that across the board here. Uh, for AMD, it didn't happen. For Amazon, it looks like it didn't happen. For Coinbase, it didn't happen. For Disney, it didn't happen. For Google, it didn't happen. For which one? Oh, for OARK. Yeah, it happened for OARK too, but not as, I guess, egregious as Tesla. But and I'm surprised, this actually hasn't been covered more on YouTube. Like, there's a lot of YouTubers that cover this, but so far I've only seen one other channel actually mention this. Um, but anyway, so of the 74 cents, 54 cents was income dividends. So you can see there was the same discrepancy here each month up until November. And then November they started equaling. Same thing for the JP Morgan fund up until November. Again, so this seemed like it stopped in November. So 28 cents here. So Meta, they didn't do it for Meta. And then for the others, let's see. For the new ones, we've got Box 3 non-dividend distributions for Apple. Did I cover them all? So Apple has what they call a non-dividend distribution. So does the ARK Innovation one, the OARK. JP Morgan has that listed also. So the ones that did it in box 3 on page 3 of 4, um, they have, I think, the difference listed as non-dividend distribution. So on this page, 3 funds did it out of this list. And then if we look at this page over here, we can see Tesla. For 10 out of the 12 months of last year, they did it and then they stopped. So, whatever this was, to be fair, it seems like they stopped, but it did happen. So, I hope that answers the questions about return of capital. Let's see. Personally, I'll be diversifying my money across a lot of these high yield funds and hope that at least a few can continue to pay out those big dividends long term. Well, like the saying goes, you do you. You like income, that's good. Um, but because of the covered call strategy, so if we go back to 2022, my theory on this, 2022, it seemed like nothing worked as far as investing. So covered calls became a good way to make money. I was doing it myself. Um, and so these in 2023, the next year after, these funds that are covered call ETFs become very popular. But the thing is, because of the covered call strategy, none of these, even with total return, none of these are ever going to outperform the underlying. And like I've seen other channels point out, these have a 1% expense ratio, and they're not going to outperform. So a stock, if you buy a stock directly, what's the expense ratio on a stock? Nothing, right? Because it's a stock. You may have some hidden transaction costs and whatnot from your broker, but most brokers aren't charging a fee anymore unless you're trading options and stuff like that. But with these, you're going to pay a 1% expense ratio, and you're getting kind of you're getting income, but it's synthetic covered call premium is what it is. Um, the results will be amazing, like you show examples in a few of your shorts. Well, so let me clarify on that, because those examples are like if you take a finance course in college, which you may or may not have, but they give you very like overly simplistic examples. So I do that. I don't want to say I do those. Like, I mean, it's a real example. Okay, if you maintain a 50% rate of return for 20 years, you're going to be insanely rich, right? But if that 50% is return of capital, or it comes out of the NAV of the fund, then it's like you're just kind of paying yourself back. So, and we do have this opinion out there too. So did I finally answer your question, Dissector, about return of capital? I don't see how that's the case. Well, I'll let you two hash that out. Almost all the high yield funds are tech sector, not going to be diverse at all. Well, that's true, because in the last like 5 to 10 years, tech has really been the best performing sector. Let's see. It would be a lot to type out and explain. Well, you can always join a live stream one time or something, or you can always join the voice chat in Discord. Have you got onto Discord, by the way, yet? Is it considered yourself paying back if you reinvest? So reinvesting is one way to do it, the dripping or just reinvesting on your own. I totally get that. But like with Tesla, so you may eke out a positive return, but the point is, as investors, we're looking for total. We're looking. Our goal as investors, just like the goal of any business, like anybody doing something to turn a profit, you're trying to maximize your rate of return, right? We've only got so many years on this earth, so we want to maximize our rate of return. Most of us do, right? So to do that, uh, unfortunately, Tesla over the last couple of years is not going to get the job done. It might have 5 or 6 years ago if you look at the totality. Um, but take a supplier of Tesla like Modine. Look at that; it's like a 300% return in the last year. So that's where the money would have been made, or Nvidia stock. So NVDY is great. I know this is going to be controversial. This is going to ruffle feathers, but I'm just giving it straight. I'm speaking bluntly. So Nvidia stock was up like what 250% in the past year or so. NVDY has done phenomenal. It's up 120% in terms of total return, but that return is half of what Nvidia stock would be, right? So, and I know some of you say, well, how would you have known to pick Nvidia stock? Well, how would you have known NVDY was going to be good? It's based on Nvidia, right? So, look, it's great. If you got in a bunch, if you, as the saying goes, backed up the truck and loaded up, you're doing great. But, and these are a vehicle to make money. These can be used, to generate passive income, so to speak. But like look at Berkshire Hathaway. Berkshire Hathaway's never paid a dividend because Warren Buffett's view is that dividends are just, it's that's what they are. They're money that's paid back to you from the company. They take that, they reinvest it into the company for you. If you want a dividend, if you've held Berkshire Hathaway over like 20 years, if you want a dividend, sell some, generate your own dividend, you know? Because Berkshire's like been one of the most top performing companies over its lifespan. And I know I just lost like 6 viewers by saying that, but I'm just speaking the truth. That's all I'm trying to do here. XOM and mRNA covered call ETFs would be diversify. Well, those, yeah, XOM and JP Morgan and Disney have the more stable, they have the more stable dividends. But does anyone disagree with what I'm saying? I mean, I'm happy to debate this. I'm happy to debate this on Discord. I'll even go live in Discord. I highly recommend, by the way, those of you that, if if typing's a lot of work or whatever, uh, typing can take a while, just like texting. Like I prefer talking on the phone over texting myself. It's so easy. Watch this. I just live in Discord in the voice chat. Anyone can join my Discord. Anyone can talk to me on Discord in the voice chat anytime. Anytime I go live, right? So if anyone actually disagrees with me, I'm more than happy to speak to anyone directly about it. Okay, so let's see. What did you say here? Okay, I read that one. Esther CH. Return of capital equals the amount of dollars that's used to purchase the investment. Um, let's do this here. There's different, everybody kind of has their own definition on stuff. Okay, return of capital, this is good. This is from Investopedia. This is pretty much how I would sum it up. Return of capital is a payment an investor receives that's a portion of their original investment. So what I just broke down, what Tesla was doing, a lot of it early on was return of capital. It's also known as a capital dividend, and it's not considered income or capital gains from the investment. That's a key distinction. Return of capital is not considered income or capital gains from the investment. And I get that a lot of you may not understand that. That's why you're here listening to the coach, and that's my job to coach you all on this, right? I don't expect everybody to be seasoned pros on this. If not, I mean, if so, you probably wouldn't be looking for uh, investment videos on YouTube, right? So anyway, oops, I wasn't sharing the right screen. Okay, let's do this here. Okay, let me actually go to the definition here. Okay, here is the definition from Investopedia. Return of capital, ROC for abbreviation, is a payment an investor receives that is a portion of their original investment. So if you have $100 and the investment pays you 10 cents in return of capital, you're left with, I'm sorry, $10, you're left with $90. And if the $10 is return of capital, that's $10 off your original investment. Now, if the investment grows to $110, then $10 is your capital gain and you actually made money. We invest to make money, just like we go into business to make money. So there's a difference between a capital gain and return of capital. So hopefully I cleared that up there. Okay, let's see what else we got here. Hypothetically, a stock that lays a dividend of 20% a year is going to do better long term than, let's say, the underlying that has 1 or 2 years where it went up 30%, correct? No compound interest without dividend. Not necessarily. I can kind of see where you're coming from with that, but okay, we got some talking to do here. Um, did my video freeze? Oh, I don't think it froze on my end, but anyway, I don't know what's up with that. Um, Maybe the powers that be don't like what I'm laying down here. Who knows? Um, so compound interest is phenomenal, right? So compound interest is the way that we grow our money, of course. Compound interest doesn't just come from dividends, it comes from any form of capital appreciation. Um, Look at Nvidia stock. That's exactly why an investment in Nvidia of $10,000 in 1999 would have you millions by now. It absolutely is. I'm not talking about uh, compound interest at all. I 100% agree, and I've actually said that in one of my first videos. It is the eighth wonder of the world, and that's not I'm not talking against compound interest at all. If if you have a fund that can maintain its NAV at what it is and grow and have a 50% dividend per year, you'll be insanely rich. The thing is, more often than not, a lot of them are not going to be able to maintain their NAV. Let's see, off topic, but DXYZ ETF got me wrecked. Well, yeah, that one I could see that that was going to happen because that one went like way up. And as they say, what goes up must come down. But when something skyrockets like that, it's usually not necessarily conversational. Well, thank you. I'm glad. I wanna dish out accurate information. I'm not just like a YieldMax shill on here. I mean, I'll cover the dividends, of course. I mean, you know, it's a high dividend rate, and it gets a lot of attention for sure. But that's it's about total return, right? And like I've said, 16 of the 22 that have paid dividends, they're positive in the total return. So if you're positive as an investor, you know, you're doing good. But I'm just pointing out that almost all the underlyings are doing better. So anyway, I guess I froze for a minute, but I'm not sure. Let's see. Jay Boy says, I agree with max return, but what a business really wants is cash flow, which is what these high yield ETFs provides. Long story short, two ways to skin a cat. What a business really wants is, yes, a business certainly does want cash flow. Absolutely. Cash flow is the lifeblood of any business. Positive cash flow, I might add. What these high yields. So I would disagree to an extent. If it's return of capital, it's not cash flow. I would disagree with that. Because remember the definition of return of capital. Return of capital is not capital gain. So therefore, it would be a negative cash flow. The $100 example, if if you're getting a $10 return of capital, they're giving 10 of your dollars back to you, and you're left with 90. That's not a positive cash flow. Anyway, who would have thought a dividend update would be so involved? Okay, we got that one. Let's see. Thanks. Yeah, I'm seeing it wrong. Well, I'm happy to have you join the Discord and come talk about it. Nvidia going up isn't compound interest. Their business is growing. There's a compound effect. So compound interest doesn't just come like from dividends. I mean, you can get it in money markets, you can get it wherever, CDs, treasuries. Yeah, dividends, if you reinvest them, you can get the compounding. Actually, there is a study that over 40 years, the S&P 500, a big portion of the growth was due to dividends. So I'm not disagreeing, but stocks like Altria that pay like a real, full dividend that's actual cash flow out of the company, you know, like 8 or 9%, companies like that are in the S&P, that helps the total return. So, well, thank you. Glad you like it. I'm just being accurate. Like I said, I'll have him on and talk about this. We'll talk about, hey, what happened with this, because I haven't actually uh, brought this up before. So okay, let's see, what other comments do we have here. Stock buyback isn't compound interest, but does increase share price. I agree. That's true too. Um, so let's look at, like, you could say the same thing with Nvidia. You could say the same thing with Apple. Um, God, I could do this all day. I've been going for 30 minutes. Time flies when you're having fun, right? Okay, so Nvidia. All right. So compounding. Dang, I should have bought in at like 7 something. And to be honest, like, I'm speaking from a personal standpoint because I bought into Tesla last year. I would have much rather gotten Nvidia directly. And I'm not talking it down. I followed the chart for 3 months, and it followed very closely with Tesla stock. It was like almost identical, but it was paying annualized a 70% yield, right? So, but another thing too, which if you listen to Blake, he's pointed out, is hedging. So if you're going to be in these and you're concerned about NAV erosion, and Jay himself has said this too, hedge, hedge with protective puts. It would have been a great way, like say you were invested in Enron back in the day, and Enron went bankrupt, of course, or Lehman Brothers. If you had protective puts on companies like that, you wouldn't have lost your whole investment. And I'm not making any comparison. I'm just pointing out, two companies that did happen to go bankrupt. So hedging can be great. And in fact, Jay has a book called Buy and Hedge. Okay, so there is and this is tricky, like I don't profess to know everything either, but since NVIDIA debuted, a 208,580.72% return, there is, I would say, a compounding effect to like the growth of a business. It's the market life cycle. It's like you look at when a business goes from infancy to maturity, there's a compounding effect within that. You look at it's like a J curve, you know, unless the business ends up declining. I mean, look at Amazon. Like a lot of these companies, that there's a compounding effect to growth. So let's see. What else do we have here? Year one of the comparison is the same to what the S&P. Well, I'm sure. I mean, it started out. My hedge is SCHD. You all love SCHD. Um, compound interest time, not capital gains. Yes. Okay. Okay. Well, I hope I cleared some of this up. Every other year, you'd rather have the stock that pays 10% dividend versus a stock that went up 10% in capital gains. Um, it depends on your tax preferences, I would say, because dividends are treated as ordinary income if they're not in a Roth IRA. So you would want, it all depends, to each their own, like they say, you do you. But me, I am not looking to retire. I mean, I'd love to retire tomorrow, but at the same time, I think like I want to work too. I'd like to do the YouTubing full time, but this is complicated stuff here. So I'm not looking. Let me say it this way: I'm not looking to retire tomorrow. So I wouldn't mind being in a stock like Nvidia that over like 5, 10, 15 years is going to do me, like it did, like since 1999, right? Go smoke a blunt live on air, like Elon Musk. I just see them as they come in. You're so passionate today. You're just like typing away. So, I'm trying. I'm just the messenger. Like they say, don't shoot the messenger. But anyway, um, I'm trying to navigate these waters too. Like the YouTube space, we've got people that love YieldMax, we've got people that hate YieldMax, we've got people attacking channels, and you know, I just want to be in the middle, I guess. And sometimes in the middle is the most dangerous spot to be because you can get something from both sides. But anyway, um, all right. What's going on with my internet connection, but it just like went out for a second. Um, FEPI has options now. Yeah, you can hedge. Vertical put spreads, honestly, are over my head. First day off in a while, get to see you, of course. Oh, of course, I know. Like, that's like at the top of the list, right? Anyway, all right, something froze with the internet connection, but I'm going to end it there. New investor, I would encourage you, join the Discord. You'll join and learn a lot. I would really encourage you to create an account and join the Discord. If you can hear me, new investor, I would encourage you, create an account, join the Discord. You'll learn a lot. NVIDIA is going to do a 4 or 5 for 1 split. Well, I think I won in before then, honestly. As a retired person, I'm enjoying the dividends but not counting on them. That is a perfect way to look at it. Spot on. Couldn't have said it better. All right, you all. Thanks for tuning in. Like, comment, and subscribe, and we will see you all in the next one. Take care. Bye.